Yep, people, you know it. Thursday, Thursday, March 9th. G Swizzle here, joined by EY from SoFi. Dan, I think, is on a plane. Maybe he's gotten off it. I have no idea. Going to parts unknown, a much needed and much deserved, well-deserved vacation for him and his family. But this is Market Call. It's 1 o'clock on the East Coast. Today's Market Call brought to you by FactSet, financial data and analytics powered by Tomorrow. And of course, SoFi. Get your money right, all in one app. And I'm just going to say it now. Butters. That's it. Just so you know, we got a little Butters coming too. Not him in the flesh, unfortunately, but Butters work. EY, how are you? And just before we even start this whole show today, I had a great opportunity to spend some time with you yesterday, and you were outstanding, not only in the panel that you did with Stephanie Link et al. Yesterday at the Yale Club, but then you, myself, and Dan went to Current's office, and we did about a 45-minute little Q&A discussion with them, and you were outstanding.
Thank you. Hi, everybody. Here we are again, unsupervised. You know what's going to happen next week? Do you remember 1 year ago from next week? What happened? We did a show.
Oh, we did the whole thing on St. Patrick's Day. Yeah. And we brought props.
And
remember that whole thing?
Guess
and
what's
we
out
didn't
in
even
the
rehearse
kitchen?
it.
No, I don't know if I have Guinness this time, but the props, the other props are out in the kitchen. So everybody look forward to that because we're unsupervised next week too, right?
It's so good. I mean,
the two of us.
Even if we're not, we should be, because just for that alone. I mean, I remember when we did that. I mean, we didn't rehearse, and unscripted. I said, "And this," and you put it up, and it was just. I mean, it's for nothing else. You should watch Market Call for that.
Yeah.
Look, there's a lot to talk about today. I mean, let's look at the headlines. This jobs number, whatever number came out today, was a little worse than expected. So in our world right now, worse is better. And I know you know this, but in the knee-jerk reaction, a market that was probably down marginally in the pre-market, then subsequently traded higher. We saw some of the follow-through early. Now we're starting to sell off a little bit on the back of whatever. I think maybe the realization that, bad news might actually be bad news. But we're going to talk about the jobs number tomorrow. But what do you make of this? Is this a good sign in so much as the Fed's job is starting to work, or things are starting to sort of take hold?
I wouldn't take this as a sign yet, but here's the interesting part. So Jerome Powell, as we all know, testified in front of Congress earlier this week and said things like the totality of the data is going to determine what they do at the next meeting. The market subsequently baked in a 50 basis point hike. I think the probability of that, according to the market now, is about 65 to 70%. So that's pretty high, and it flipped very quickly from 25 basis points to 50 basis points. But here's the interesting part. So much data is going to come in before that meeting. He obviously knew that. We already got JOLTS data after the testimony. We got initial claims today. We're going to get NFP tomorrow. We've got CPI on Tuesday. I mean, just those four prints alone are huge, and that's all happening in less than a week. So there's a lot that we still have to take in. The initial claims data, and this is the way I look at it as a macro strategist, initial claims are almost like Morse code. It's just kind of like a tick, a dot that happens every once in a while. They're so high frequency and they're so susceptible to quick swings in one direction or another. This is one of those data points that you cannot look at one piece of it and say, oh, the trend is beginning. Look at continuing claims. Those have continued to go up, no pun intended. Those have continued to go up slowly, but they've risen and they're at their highest levels since, I think, last year or maybe even 2021. So something to just pay attention to. But I don't know that this initial claims data is something that we should extrapolate into what's going to happen tomorrow morning.
Yeah, I agree with that. And it's interesting. You're still seeing 2-to-1 in terms of job openings versus people that are looking for a job, which is a staggering number when you think about it. I mean, it's been that way for quite some time. So on that metric alone, it seems like the Fed's job continues to be difficult. So as to your point, though, we're going to get a lot of different data points over the next week and a half. And I do think as important as tomorrow is, some of the inflation numbers out next week will be equally important. I'm of the belief, and I'm not suggesting I'm right, but so many of the inputs that go into this number have started to trend higher once again. So I think there's this hope that things will continue to sort of gravitate, which means go lower. Gravity brings things down. But I don't know. I mean, it feels like things are starting to trend if not back up, at least flatlining. And flatlining is not particularly good, I don't think, for a Federal Reserve that still has a lot of work to do. Thoughts on that?
That's right. Well, and here's why we call services inflation sticky, because it doesn't go down as easily. You can't affect it. And back to economics 101, what causes inflation? It's an imbalance between supply and demand. So there's two options on how to affect it. You can increase supply enough to meet that strong demand. Well, when we've got a shortage of workers, to your point, 2 to 1 jobs open per unemployed person, you can't increase supply because you don't have enough people to provide the services and you don't have enough people to make the widgets. So inflation stays high because of that lack of supply. So you have to bring down demand. So we're stuck in this space where, yes, bad news is good news to some degree. But here's the other thing about the job market, and this is what I want people to watch. It's like a boulder that starts to slowly roll down a mountain, right? So we're going to see indications if it does in fact break. You start to see indications and the boulder starts to go really, really slowly, but then it picks up steam. You can't stop it once it starts rolling. If you look over historical periods of things like the unemployment rate, initial claims, continuing claims, non-farm payrolls, they sort of creep up and then they just spike. So be aware that if we start to see a trend in that direction, it could speed up a lot faster than anybody expects.
So that's a great point. Obviously, you only make great points, but once it starts to move, and if you think you're going to and now I'm talking about the Federal Reserve again, if they think that they'll get unemployment to a certain point and then they'll be able to stop that boulder, they won't be able to. So the same way that they magically thought they could get inflation and then control it once they got it, now the hope is to sort of raise unemployment. To your point, if you can't increase supply, you got to kill demand. And how do you kill demand? Well, you make things difficult for people. And how do you make things difficult, people? You watch the unemployment rate go up. I mean, that's effectively what's going on here. But to think they could sort of stop it when it gets to a certain level, and using your boulder analogy, is as improbable as it was to think they could control inflation once they got that. And look, I mean, I'm not here to beat up the Federal Reserve. I do it on a daily basis. But that's the thinking behind it, that they can control something that they have zero control over. And you've brought it up a number of times. These construction jobs, they can go away at the drop of a hat. And you're not talking about a few hundred jobs. You're talking about tens of thousands of jobs. And as quickly as things seem robust, that can go away in a nanosecond. And quite frankly, I mean, it takes a long time for that tide to turn the other way. So I think you make a great point. I just wanted to amplify it a bit, EY.
Yeah, well, and the other thing, thank you. The other thing that you want to look at is unemployment spikes very quickly right before a recession. It takes a lot longer for it to come back down. So it goes up. It's almost a reverse roller coaster, right? It goes up this really steep trajectory and then it sort of slides back down. So it takes a while. If you get up to an uncomfortable level of unemployment, it takes a long time for it to get back down to what we would consider a healthy labor market. So I do think that, the Fed has gotten a lot of criticism. I would say, I don't know that there's a Fed, and maybe you tell me, I mean, you've been around just a couple years longer than I have. Has there been a Fed that hasn't made a mistake?
Yeah.
Has there been a Fed administration that's done it right all the way through?
Yeah, that's people obviously will point to Paul Volcker, but I will tell you, having lived through it to a certain degree, there were not a lot of Paul Volcker fans at the time. And, but to your point, probably not. And, here's the conversation really, and this is for another show at another time, and it's much longer. And the question that I would posit to a lot of people, should there be a Federal Reserve? If you think about it, I mean, what is really the role? I mean, are they trying to control things, quite frankly, that they have no control over? I would submit, and again, incorrectly, probably, that if you just let market forces actually work, and if you let capitalism work the way it's sort of constructed to do, yeah, there are going to be periods of time where you need somebody to come in and pull a circuit breaker or sort of slow the tide, but not at every frigging turn and with every market permutation. So that would be my pushback there. And I think there are a lot of people that would agree with me, but I think that's neither here nor there, as they say.
Yeah, well, sometimes transparency can be too transparent.
Mm-hmm.
And I think that's the world we're living in right now. Every single word that comes out of Jerome Powell's mouth can move the market 500 points. And that's just, honestly, that's no way to live.
No.
And we're kind of stuck in this fight. It's also difficult when you have a week like this week, where you have a down day that's really violent after some comments by Jerome Powell. It's difficult to look at a day like that, step back and still see whatever that saying is, the forest for the trees
Yeah.
or whatever. We're so buried in this day-to-day minutia. We're buried in every single data point. And that's why I sort of downplay, even though it would actually support my thesis that this initial jobless claims spike is, it's happening the way I expect. But I'm downplaying it because it's such a high frequency piece. You never know what happens next week. I don't trust it yet.
I agree. So let's take a look at the S&P just for context. I mean, yeah, it feels like we've had a lot of movement, but effectively we're sideways now for quite some time. Yeah, it's a move to the upside, downside. That 39.40 level, that S&P level we traded down to a week or so ago, that was the 200-day moving average. Dan and I have outlined it with Liz as well a number of times. We bounced off it in a pretty significant way. I think we got up to 40.80 or so, and that actually triggered, I don't want to say a response mechanism for Mike Wilson, but I think he said to himself, all right, technically we did what we did. We held. We're going to see a pretty robust bounce here. And he made a call earlier this week that we highlighted, maybe 41.50 or so. And we posited here, to use the word again, is he being too cute? And that's not me being derogatory. I was just questioning whether or not you want to be that tactical in the course of what's going on. But here we are again. So we're about 40 or so handles away from that 39.40 level. The question is what happens, and I'm not asking Liz to play stock market here, but this is how I would look at it. This is how I would trade it. I mean, let the lines speak for themselves. If today's one of those days where we hold and then tomorrow you get a bad number being obviously worse than expected, possibly being bullish for the market, maybe you have another trading opportunity. The converse, obviously, and Goldman Sachs put out a note in terms of potential outcomes, a jobs number north of 500,000, they thought the market could go down 2.5%. I mean, I think they're guessing like everybody else, but that's the way you have to sort of game it out. In line is probably good enough to get a bounce, but if you see some robust numbers unexpectedly that continue to show stickiness and the tightness of the labor market, I would submit that 200-day moving average is in jeopardy and that trend line is as well. And, I know you don't look like nearly as close to this stuff as Dan and I do, but is that sort of accurate in terms of how I'm looking at this thing, EY?
Yeah, well, first of all, the numbers on the jobs report are always unexpected because the estimates are so bad. They're so far off. I think they've been off. They've underestimated jobs added for 10 months in a row, something like that. So I'm going to say that their batting average is poor, if not deserves to go back down to the minors. Here's what I think could happen. Let's say we get stronger jobs than expected tomorrow, or at least marginally stronger than last month. And we have a hot CPI report on Tuesday. Yes, I think we blow through that 200-day moving average pretty easily and are on our way down. If we get an inline jobs report and a CPI report that shows some progress, even on services, I think that's a rally. I think the market wants so badly to rally. But here's the thing, and to your point about Mike Wilson and making a tactical call, I often think about meteorologists and strategists as sometimes a similar profession. If I were to come on and say in the beginning of January, you know what, it's going to feel like spring for the next 15 days. Get excited about it. Okay, fine, get excited about it. The reality is it's still January, it's still winter, all right? I'm not going to try to make a call that's that quick on the upside, because that means I also have to be right on the out, right? When the inflection point hits again. So I think that's the tricky part about Mike's call, is that yes, he's positive in the near term, but he also then has to be right on the other side, because if he's told people that it's going to rally, they're probably going to buy on the back of that. Then he better be ready to tell them to sell. And I think that is nearly impossible to figure out, especially in a time, to my point earlier, when we are obsessed every single day with every single data point. So look, we could go, honestly, I think it's a coin flip in the next 3 days of which direction we go here. I still, though, don't think that it changes things over the next 3 to 6 months.
I agree with that. And so let price be your guide. I say that all the time. It pisses people off. And let me ask you a quick question, because this has always confused me. I don't know if you have the answer to this, so I apologize ahead of time. When you see these meteorologists come up and say we have a high pressure system, high pressure to me means that it's high pressure, like you feel things on top of you. If heat rises, my sense is a high pressure system is a cold front coming through, and a low pressure system, meaning heat rises, means that a warm front is coming through. Is that accurate, or am I out of my effing mind?
I guess I never thought of it that thoroughly, but I always thought a high pressure system meant that we were going to have a bright, clear day. Usually it happened in winter. So that would be a cold, bright day. I think they call that a bluebird day. I don't ski, but something like that. Yeah, I always thought high pressure was actually a pretty looking day, right?
Well,
Blue skies, sunshine.
But that's what we do. That's what we do here on Market Call. Let's quickly look at the NDX because why not? It's going to look similar. It's interesting. Again, Apple continues to show some relative strength. NVIDIA, we're not going to get bogged down in that, but that continues to defy logic, in my opinion. Google has found at least a bottom for now. It appears as though that's the case. The interesting name, Tesla, quite frankly, that move from 218 now below 180, I think it's caught a lot of people off guard, but this is the same thing. I mean, it looks a little healthier, I guess, because we haven't given up like the S&P has, but I still think we're vulnerable here. We don't have to get bogged down in it, but what I want to look at are yields because that continues to be, I think, top of mind for a lot of people. So if we look at the yield chart quickly, I mean, we saw a 2s10s invert to the tune of, I think, 110 basis points. Today, it's probably closer to maybe 103 or so. Blew through that 100. Here's the chart that we drew. We're not suggesting we're right, but, we've pushed up against a certain level in 10-year. This is the way I look at this, Liz, and please push back or, give your theory on this thing. I think that if, in fact, the market does start to sell off and people realize that this economy is slowing in a meaningful way, I think almost by definition, 10-year yield should go lower. On top of that, you might see a flight to quality in the form of 10-year yields, in the form of the bond market, which would take yields lower. So I think at these levels, and I'm just talking about 10-year now, sort of longer dated maturities, I actually think there's a chance that bonds rally and yields go down, but they don't go down for particularly good reasons. One of the reasons is because there's a flight to quality on the back of an equity sell-off. Thoughts on that?
Absolutely. Well, so I think the big question mark is this, we're going to see CPI data obviously on Tuesday. If that comes in hotter than expected, you're going to see inflation expectations rise. I've talked about that a few times in the last few weeks. Inflation expectations since the beginning of the year have spiked quite a bit across all of the maturities. So if you look at 2-year expectations, 5-year and 10-year, but 2-year in particularly has spiked, which started to tell the market the Fed has lost control of inflation, at least in the near term. If there starts to be a sell-off, this goes back to actually the previous chart of the NASDAQ. I think I said this in January at some point. I'll have to go back through the archives on YouTube. I expect this year if we see sell-offs, right? If we see drawdowns, and especially one of the type that you and I and Dan are expecting, I think it's going to hit cyclicals harder. So that doesn't mean that the NASDAQ won't fall in a drawdown. But I think last year, given that it was such a rate-driven volatility environment, is going to be different than what we see this year, even if it is a volatility environment. So you're going to see different sectors sell off in a pullback. That's why there have been some points in days this week even where you see the Dow down, but the NASDAQ up. Even last week that happened a couple times. So you see things in the cyclical area falling harder than things in tech, communications, and discretionary. As far as the 10-year yield, this is where I think it's going to get interesting because if yields fall due to fear, the 10-year definitely will fall due to fear. People buy it out of just being scared, right? But I think the short end falls as well. And the answer that I don't know is which one falls faster, right? Does that actually start? I think it actually would bring us into less of an inversion, meaning I think the short end would start to fall faster. But here's the other thing, guys. This is where I think we get stuck in one-dimensional thought processes. You might think, oh, that's good, right? The yield curve is re-steepening. Everything's going to be better going forward. The re-steepening of the yield curve is actually usually what happens right before a recession or when the recession starts. So that would be my guess, that if we go into fear because of a downturn or we start to confirm that a recession might happen, I think you do see yields fall across the curve, but you see the short end fall faster, which makes the inversion less.
I'm glad you brought that up. You mentioned that yesterday as well. It's a great point. By the way, Jacob, pull this up. David Grisco says, gotta wonder when Guy found time to study in school. Always on a tangent. Yes, David, you're right. I don't know how my mind works. There are few people. I'm sure they will study it at some point. But as you will see in a few minutes, I can pull shit out of nowhere. And it's fascinating to me. With that said, speaking of pulling shit out of nowhere, and we are going to talk about the banks, by the way, a lot of people asking, let's go to your note, because once again, you've pulled a proverbial rabbit out of the hat with this Chutes and Ladders.
Chutes and Ladders.
And
games.
by the way, I will tell you, I know this was a game. I didn't play this game. Red light, green light, however, 1, 2, 3 was a game that we played. Now, for the folks watching this, my sense is 97% of the people have no idea. But red light, green light, 1, 2, 3, just for the folks playing our home game. One person stands at one side of, let's say, a basketball court or something like that, and turns around and closes their eyes. And then 5 or 6 people are on the other end. And that person says, the one person says, red light, green light, 1, 2, 3. And on 3, those people have better stop running towards him or her. Otherwise, they're out. That's how we entertained ourselves in the 1960s and 70s.
Yeah. Well, look, it didn't get much more advanced in the 80s and 90s. I mean, I did a lot of kick the can, red light, green light, although there was no 1, 2, 3. We did Red Rover, all kinds of stuff. This is what you did in the streets of Wisconsin.
Yes, noted.
Anywho,
please.
Game theme this week, Chutes and Ladders. And this goes back to the earlier point that we are so data dependent, we're obsessed. No matter what the point is, it either takes us down a chute very quickly, or we make another notch on a ladder. We go up another rung, on a ladder. A notch would be on a belt. Up a rung on a ladder. So that's why I called it Chutes and Ladders. And then we start with red light, green light, because that's also how this feels, right? What happened this week? We had Fed commentary, we had a testimony, and look at how flip-flopped the probabilities of 25 basis points to 50 basis points went in a matter of like literally 15 to 20 minutes. So it happened so fast, turned into a red light very quickly for the market. My point of this whole column was that there are actually quite a few data points that changed considerably in the last week. So we've kind of been watching a slow moving beast in a lot of these different areas. And then suddenly we had a few that changed a lot. You mentioned construction employment, and I know I mentioned this on one of our panels yesterday. If you look at the JOLTS data, yes, there's still a lot of jobs open. There's still 5.1 million more jobs than people available to fill them. So the labor market is still tight, make no mistake. However, the quits rate came down, and just think about that from the University of Common Sense. If you are no longer as confident that you'll find a new job, you're not going to quit the one you have. So fewer people are quitting. That's an indication. The other thing is that construction jobs open fell 49% month over month. Now you might think to yourself, well, these are January numbers. Not as many people are building houses in January. The funny part about that is that go and find a headline. Everybody's going to tell you that January was seasonally warm. So of course they should have been building houses, right? You have to start to line up the things that don't make sense. And yes, January is probably usually a lighter month for building houses. The reason, though, that construction employment matters is because it tends to lead the broader labor market, and the correlation between those two is tight. So construction employment starts to weaken. You'll see the broader labor market usually follow within, I would say, 3 to 6 months. So keep your eyes on that.
One of the games I liked playing as a kid as well was Operation. Frustrating as hell. Obviously, some of the pieces easier to get out than others. It's one of those things you wound up breaking invariably or losing, like, Adam's rib or the friggin' rubber band. But, I digress yet again. I probably have one of the games lying around. And if the bulb burnt out on the Operation victim's nose, then you were shit out of luck. Anyway, talk to me about this.
I didn't really like this game. I didn't like Operation. It wasn't my jam. I didn't really understand what the objective was. You just tried to take the bones out, and how do you win? I didn't get it. I didn't like it. But this was my point about construction employment. So look at how tightly those lines track each other. You've got the total employment in the dark blue line and construction in the light blue line. That drop, this recent drop, obviously stands out. So it's been pretty volatile for the last few months, but that is a much bigger drop by a magnitude of 2 times than what we've seen in the last few months. And I think that probably, more than initial jobless claims, this is probably the canary in the coal mine. So this is definitely something to watch.
And
but
it's
Guy,
interesting.
wait,
Quickly,
I want to tell, go ahead.
Tell the folks at home. Go ahead.
Well, I was going to tell them, I used a few, I did play Chutes and Ladders. I was a big fan of that one. My cousin also was a big fan. I did not play Operation. I did play red light, green light. My favorite game as a kid, and I thought I was going to save this as like a big reveal for our viewers, which will still be a big reveal. Guy guessed it before he even said it. He said, I know what your favorite game was. It was Candyland. I don't even know how you knew that. It's true, though. It was Candyland. I wanted to play it every single day.
Because as I've told people, the cheapest thing you can do is pay attention. So over the course of the last
when have I talked about Candyland? I've never talked about Candyland.
No, you haven't. But as you say, you got to connect dots, and there are all these little different data points, and it's all a puzzle. It's a pastiche. It's a mosaic that I'm able to sort of put together. You need to pay attention. For you guys and gals out there, again, pay attention. You'd be shocked at what you can learn. 2 ears, 1 mouth. Use them accordingly.
Okay, what? Only because Dan isn't here, I'm going to go off on a tangent real quick. I can't believe I'm going to admit this story. In the game of Candyland, for those of you who don't know, you got to make it through this maze, and you got to get from start to finish, right? And you pull cards along the way that tell you where to put your piece. There was a card. His name was Grumpy. And if you got Grumpy, if you pulled the Grumpy card, you had to go almost all the way back to the beginning. So when I was a kid, I would get so mad. I was a little competitive. I would get so mad that Grumpy came up. I bit the card.
No,
and
you did not.
I bit it so many times that it had teeth marks in it. So then it turned into the most identifiable card in the stack, and it would come up, and I would run. If it came up, I would run away and refuse to pull it. Just quit the game.
Be.
And my mom was like, I don't know what to do with this child.
No. And your sister was probably, I'm sure she was the one playing by the rules, right? The
my
petite
cousin,
one.
Usually.
You were the one with pulling grumpy cards out of your mouth.
I was outside. I was out in the yard at the neighbor's house. Like, I'm not pulling that card. Anyway, enough.
That's
enough
fantastic.
About that.
You know what? You must be playing Monopoly with you must be just a hoot, as they say. Anyway, let's take a look.
Emotions more under control now.
A lot of people are talking about Silicon Valley Bank. So we have two charts to illustrate what's going on. So this is not a small bank by any stretch of imagination. I mean, look at the magnitude of this move today, and look at the amount of volume. It's a 40% move we're seeing in a bank that probably, as you told me before, market cap is still probably $9 billion. So longer term chart, just to illustrate the absurdity of this entire thing. And I said to Liz before the show, I mean, this could be a DocuSign chart. This could be any number of Cathie Wood's ARK ETF holdings. I mean, that's exactly what it looks like. The only difference here, it's a bank. Now, I'm not suggesting there's any systemic risk at all, and maybe this is Silicon Valley specific. But one of my concerns has been, the lag effects we see in the economy. Are you starting to see lag effects taking hold in some of these banks? I don't think it's coincidental that some of the big money center banks, like the JP Morgan's bank, Citi down today as well. I don't want to be an alarmist at all. My sense is this is probably specific to Silicon Valley Bank, but you have to take notice when a significant institution like this is down to the magnitude that it is. And you had some of the metrics in terms of, the offering and stuff and why it is seeing this move. But that's a bit of a shocker here, EY.
It is. Well, it is a shocker, especially because it's a bank, right? If we were talking about a startup tech stock and we saw a chart like this, although still disappointing if you were an owner of the stock, probably not as surprising to see such big swings. Nobody wants to see this in a bank stock. And I think what it's doing is other banks have become guilty by association. And there's sort of this now trepidation of, oh my gosh, are there banks out there that have capital issues, that have liquidity issues? What I will say about that, just to quell some fears, if there are fears, there are tiers of what are called strategically important financial institutions. And a lot of the big banks that you would think of, you can rattle them off, JP Morgan, Citi, they fall in certain tiers where they're required to keep much more capital than other banks on that list. And even the Bank of New York Mellon, when I worked there, that wasn't even tier 1. So if you look at that list, and that's all publicly available, go ahead and look it up. So those banks are required to keep a certain amount of liquidity and capital available. They are better capitalized than they have ever been as a result of 2008, 2009, so that we wouldn't go through that again. This, however, some of those stats and why this is down to this magnitude. So this bank right now is trading at a market cap just over $9 billion. They announced a stock offering. I believe it was $1.25 billion of common stock and $500 million of preferred. So $1.75 billion total, which is almost 20% of their current market cap. So that is a huge offering. In addition to that, they announced a sale of all of their available for sale securities off the balance sheet. So clearly they needed to raise some capital, which then I think made everybody worry that there was a liquidity problem and that they were sort of panicking. It sounds like they've raised enough, but obviously the stock is suffering. And, the other thing I would say about this is when they made this decision, they knew the stock price would suffer, right? It's not as if this is a surprise to them necessarily. And it's an announcement that I'm sure most banks don't want to have to make, but they're taking steps in order to prevent, hopefully, something bigger down the road. I do think the fact that this bank is so exposed to Silicon Valley, and I believe, I don't want to speak out of turn here, so correct me if I'm wrong, but I believe they provide a lot of financing for small businesses that are just starting out. So I think that probably their portfolio is a bit more high beta than what you're going to find in the bigger banks.
No doubt about it. And the hope, obviously, and watch what I do here on the fly. The hope is those tiers, TIERS, don't turn into, wait for it, tears. See what I did there?
Yeah, I think we all see.
Yeah, thank you. Before we 5,000, I promised Butters. Well, let's pull up Butters, his FactSite earnings insight. And this basically, he's looking at the amount of times recession has been used during fourth quarter conference calls, numbers above the 5-year average and the 10-year average. However, it looks like we're declining. Now, I don't necessarily know what to make of that. So I guess it's declining in terms of the amount of times we hear it, but it's clearly still top of mind. And I say this all the time. I'm not smart enough nor humorless enough to be an economist. But for a lot of people, it's a lot worse than that. But it's just interesting to see that maybe that's cooling, and maybe that, in fact, is a good sign. Maybe it's one more little nugget that we sort of store away and come back to in a few weeks.
I don't know. I don't know that I trust this either. I think that a lot of times the commentary blows like a field of wheat. So the wind blows a little stronger. Everybody kind of leans one direction. The wind changes course. Everybody leans the other direction. I think that this is maybe not quite as fickle as consumer sentiment readings, but it's up there with fickle readings. And CEOs realize that if they're the sort of standout turd, I'll call it, saying that a recession is coming and everybody else in their sector is saying things are fine, that it's going to make people think that their company is just not prepared or that their company is in a worse position. So I don't know how much I trust the mentioned stuff. I think it's interesting as a headline. I don't know how predictive it is of going forward return expectations.
You don't want to be a turd ever.
No.
By the way. By the way, since everybody says I only pull out bad comments, let's pull up Shoddy's comment, who's now said it twice. But since he's being kind to me, shout out to Guy, who single-handedly, 1, predicted the triple-digit oil in 2020, 2, warned about inflation, saying, be careful what you wish for, biatches. I didn't say that part. He didn't type it. And 3, predicted triple-digit rate inversion. So thank you for paying attention. As I mentioned earlier, the cheapest thing you can do, Shoddy.
Yep. And you know what, Guy? You are right more than you're wrong. And you don't give yourself enough credit. You do a lot of self-deprecating humor. I'm being really sincere. A lot of self-deprecating humor, which I think we all laugh at heartily. But you don't deserve it all. I think that you are right more often than wrong, especially when you pound the table about something. I always think to myself, I bet that's going to happen. Just wait.
You know what? You're kind to point that. Listen, I appreciate that. And in our business, it's all part and parcel. You're going to be wrong. I like to illustrate when I'm wrong because, as you know, there are a lot of people out there that will tell you their track records and how great they are, and they've never had a losing trade. But that doesn't help anybody. I think sometimes by illustrating the bad calls, it's something we can all learn from. But you're kind for pointing it out. So thank you. Enjoy. You have a happy hour coming up tonight. So good for you. Are you going to be on that octagon box tomorrow or no?
Nope. Not tomorrow. I have halftime tomorrow. I'll be on the IC.
Of course you do.
Be on the IC from the NYSE.
You're gonna be on the IC with the SDs on the NYSE, and I'll leave that to the people's imagination. Listen, I want to thank Elizabeth Young, EY from SoFi, for joining us. I want to thank our sponsors, FactSet and SoFi. I want to thank our audience. I hope Dan is now on a beach with whatever alcohol he chooses to drink, probably some sort of tequila thing. We won't be back tomorrow unless something bizarre happens, but we will be back on Monday. So, Liz, thank you. Thank you, everyone. And we'll see you soon, folks.
Later, guys.